Hello and welcome. We have a prolific guest here and a name to reckon with in the fixed income marketplace, Mr. Suyash Choudhury, Head Fixed Income at Bandhan Mutual Fund. Suyash has been in the industry managing the fixed income funds for more than a decade now, and he's shown his prowess through interest rate cycles as well as credit cycles. So, welcome Suyash. It's pleasure to have you here on this platform. This is JM Financial's Video Zine Horizon.
Thank you so much for inviting me. It's an absolute pleasure.
Thanks. Suyash, these days and especially post 2020, the world has been going through a lot of turbulence. It started with the pandemic, then the war, and now hyperinflation crisis in terms of food grains and commodities not being available, and suddenly there was an interest rate rise. While developed countries are struggling with something that they thought was behind them, some of the developing countries have their balance sheets very stretched. Do you see some of the countries or some of the economies really getting into trouble because of this? What does the world look like in this situation?
So, let's go back to when the pandemic started and, what the individual responses were from various large nations around the world. Now, if you recall, developed markets, specifically led by the US, were very aggressive with their fiscal responses. So, part of it had to do with the ability to borrow and spend. Because you are running the reserve currencies of the world, and therefore your ability to borrow is that much higher. And partly because probably it was felt that the situation needed that bigger fiscal response. Of course, the monetary response from agencies like the US Federal Reserve were also very large. But chiefly, I think, the big variable to focus on is the very, very large fiscal response, specifically in the US, but also in many other developed markets. Now, as you know, the way the pandemic has worked out is it was, in a sense, in an economic sense, a stoppage of time. And I don't mean from a welfare sense here, I only mean from an economic sense. And therefore, as activity restarted, a lot of economic variables came bouncing back, and especially with the benefit of hindsight, it is now clear that the developed market fiscal response was excessive. And that actually, alongside supply congestions, led to a very significant bout of inflation. As you referred to, it's something that many of these systems have not envisaged in the last 20-30 years. Now, if you recall, last year you had two additional problems. You had a very large spike in commodity prices because of the Ukraine-Russia war. And then you had ongoing supply congestions because there was start-stop opening, shutting down of various parts of the world. And therefore, inflation was pretty much a global problem, maybe outside of China. Right, because you were experiencing supply shocks, you were experiencing congestions, you were experiencing commodity prices which were high, and then there was demand pull inflation in many of these economies. But it was very hard to distinguish who is facing a very short cycle inflation and who's facing a longer cycle inflation last year. Now, as we stand today, a lot of these supply congestions are behind us. A lot of the hard commodity shock is behind us as well, although agriculture and food prices have risen recently owing to weather. Now, as the commodity shock and the supply chain congestion shock has receded, inflation dynamics have become more local to economies, largely reflecting the size of the fiscal response that was administered, especially over 2020 to 2022. And therefore, you see the narrative, for example, in the US, it's really the non-tradable service sector which is the chief cause of worry as far as inflation is concerned. The story to some extent is similar in other large developed market economies. On the other hand, if you see countries like India, where the fiscal response initially was well judged and well administered. As the commodity and supply congestion shocks have gone away, inflation has tended to fall back into the comfort zone of the Reserve Bank of India. Again, we are experiencing a weather-related spike right now in food prices, specifically vegetable prices, but we expect that should subside in the next 2 to 3 months. But if you were to keep this aside for a minute, we don't worry in India about excess demand-led inflation anymore. So you see, in some sense, the kind of macro response that was put on the table after the pandemic is now leading to individual inflation dynamics in various countries around the world. And markets are beginning to make this distinction. So as an example, even though US cash rates are 5 to 5.25, money is still flowing abundantly into emerging markets, including India. Had we said 2 years back that US cash rates will be at 5%, most people, including probably the two of us, would have said there is no chance that money is going to go anywhere but the US. And that's happening because economic narratives are now more dependent on what happened over 2020 to 2022. And there is a clear distinction being made in favor of India as well as some of the other developing markets around the world. There are, of course, certain other smaller developing economies which are experiencing, like you referred to, some additional amount of pain. But that, by and large, does not cover the larger breadth of systems that we are talking about. So, in some sense, we are in a situation where underlying macro dynamics are now driving fund flows. And happily for India, because of very proactive and well thought out handling over the last 2.5 years, we are now reaping the rewards of that.
And as you rightly covered, India was probably criticized for a muted response initially during the pandemic, and now we are feeling that okay, that was probably with the hindsight benefit, but that was the right response. 2023 also saw something else which was a big thing, which was a banking crisis, especially the Silicon Valley Bank, Signature Bank, or some of the other banks that saw problems. This was a second big crisis after 2008-9 in terms of banking crisis, and I'm talking about global crisis. How do these two crises compare?
Well, in fact, if you see the regional bank system crisis that you referred to in the US, it's actually a small subset of the banking system. By and large, and drawing lessons from the 08 global financial crisis, bank regulations have tightened very significantly in most areas around the world and also in the US. So as an example, capital norms have been made much stricter. Speculative activities are clearly delineated, and so forth. So if you see, as best we can figure, the large banks are actually quite fine. So there are pieces of the lending book which may be suffering some stress. One of the things being talked about is the commercial realty sector in the US. But by and large, the banks are fine. The regional bank system that suffered a crisis earlier this year was actually on account of almost mismanagement of interest rate risk in some sense, right? And that does not mean that it wasn't relevant, but it means that probably it's not a blanket economy-wide thing that one should worry about. Instead, what one should probably look at is, from a macroeconomic standpoint, that what it does to lending conditions in the system. So, one thing that more and more economists are now focusing on is that both in US, Eurozone, as well as probably in other major developed markets, bank lending standards are now tightening quite significantly. So we don't see that in credit spreads in the marketplace, which continue to be quite benign. But if you see bank lending standards, including who they want to offer loans to, what sizes of loans they want to give, at what terms they want to give those loans out, all of those are on the margin tightening quite significantly. And with a lag, this is bound to reflect in economic activity. So one of the other areas of focus in the current part of this global macroeconomic cycle is that a lot of lead lags are involved in this amount of tightening showing in economic activity. And so there's a risk that the current resilience in many parts of the world, there's a risk that we are extrapolating that, which may not ultimately turn out to be the case as the lagged impact of tightening starts to show in economic activity.
Oh, okay. Oh, so that's an interesting one, that currently what looks resilient may eventually turn the other way, and we might show the vulnerable underbelly. That's a risk that...
More from a growth standpoint rather than a financial contagion standpoint. Okay. So one is not thinking about any sort of a widespread financial contagion, but if you see, for example, the US has had a very strong first half of this calendar year. Yes. There's a tendency to then think that probably this continues. However, if you look at these, let's say 3 things that we are very focused on. See, the first is that now as inflation and inflation expectations are beginning to drop and nominal policy yields are at cycle high, the so-called real policy rates are rising, right? And that matters a lot to aggregate demand and economic activity. Now, so far, even with rate increases, real policy rates were actually still deeply negative, but that is now correcting, which means that even without further tightening of policy, the real rates are actually rising because of falling inflation and inflation expectations. Second, balance sheets of, let's say, the 3 large central banks, which is US, Europe and Japan, cumulatively now are tightening, right? So this was very slow to pick up speed, but now it's picking up speed. So, remember we always used to say that as long as, the Fed is opened up the liquidity tap, everything is fine in the world. Well, it's now happening in reverse, right? Although it's happening at a reasonably glacial pace so far, but it is happening. And the third thing which we already discussed about is the bank lending tightening that is happening. So we can't help but think that the cumulative impact of these 3 factors give it a 2 to 3 quarter lag, and that should show in economic activity.
So when we talk about economic activity, we also discussed that at US 5 quarter, the usual expectation maybe 3-4 years back would have been India can't get any flows, but India is getting flows. And there is a widespread belief that the next decade probably belongs to India. In that case, a lot of people are also getting bullish on Indian equities. Now, if that's the case, is there a case for investing in fixed income in India?
That's a very interesting question. So let me answer that in 2 parts. First, let's recognize some of the clear strengths that India has today. One very large one is the balance sheet cleanup. So remember, a few years back, a lot of lender and borrower balance sheets were actually in very bad shape. And now a lot of this has been cleaned up. Thereby, the capacity to borrow and the capacity to lend has been restored. Right? And that's a very large tailwind. With the balance sheet deterioration that was happening for the last whatever number of years, the investment to GDP ratio of the country was also falling. Now it stands to reason that with the balance sheet cleanup having now been achieved and behind us for the largest part, investment to GDP ratio should stabilize and start to pick up. So far it's largely being led by the public sector, but at some juncture, provided the global cycle stabilizes, the private sector should also kick in because they have now the ability to invest. The second, which again over the last 6 months gets talked about a lot, is India's services exports have really picked up. And so one of the vulnerabilities that an emerging market always needs to guard against is what is called the current account deficit. Yes. Now, because largely of this rise in our services trade balance, the current account deficit for India has shrunk very significantly. So from what used to be something like 2.5 to 3% of GDP, now we talk about something like 1.5% of GDP as our current account deficit. And that's clearly another strength that we are developing. And third, which is the realignment of global supply chains, etc., with India being one of the obvious beneficiaries. So these are 2 or 3 very solid reasons that one can talk about when one looks at India's inherent strength. And of course, In this cycle, we discussed how the post-pandemic measures were responsible and well administered, and that also has led to economic strength as we stand today. Now to your second question. See, there is very little doubt that relatively India will do very well, right? However, the global environment today, or let's take the next few years, is it comparable at all to, let's say, the 2001 to 2008 golden period globally? The answer very emphatically from me is no, right? So there is higher debt globally. I'm saying, I'm not talking about India here, right? So global setup, there is higher debt, there is adverse demography, and there is some form or the other of what is called deglobalization, but actually one should use a more nuanced word, reorientation of supply chains from what used to be the most efficient place to what is the most reliable place, right? So if you combine these factors, it's possible to argue that the environment for return on capital is nowhere as conducive globally, or it's nowhere likely to be as conducive globally as it was in that golden decade, right? Secondly, the risk-free rate, for a global portfolio manager, which presumably still is, let's say, the US yield. Now, the US fiscal deficit is almost permanently set at a higher level than what used to be in the pre-pandemic era. Inflation has scared Western central bankers badly enough that they will not be as aggressive in cutting rates over the next couple of years, although they will still cut rates. And therefore, the risk-free rate for the world has also been set higher. So, not only is the general global environment for return on capital not as conducive as it was in that golden decade, but also the risk-free rates of the world are higher than, not then, but recently. So, then obviously risk-free rates were this high or higher. But then the global environment for return on capital was much better. In the last decade or so, the global environment for return on capital has been weaker, but the risk-free rates have been low enough that you still had a very modest discounting factor, and therefore growth asset classes tended to do better. Probably over the next 2 to 3 years, you have neither, right? And if you were to take that as a scenario, and taking into account that India would still relatively do better, you still have to have a multi-asset allocation table. See, one of the things which I think still happens is a lot of asset allocation strategies are still drawing versus, a last 20-30 year experience, which a significant portion of that pertains to that golden period, right? And if the arguments that I am presenting today hold any merit, then the clear conclusion is that you can't only be in equities. You have to have cyclical and counter-cyclical assets in your asset allocation table. Equities, credit are all cyclical. Counter-cyclical is only and only, in a mass sense, quality fixed income. Right? Although there are other counter-cyclical assets available on a global stage, but talking about here sitting in India, one of the very large counter-cyclical assets you could have is just quality fixed income. And what do I mean by cyclical and counter-cyclical? Because economic and financial market cycles have, phases of growth and then phases of degrowth or weak growth. And the asset allocation table should allow you to sleep peacefully in both phases. Right? It can't be all chips on in one bucket, because if the argument that I presented earlier is true, or it resonates, then that cannot be the strategy. Right. Now, bear in mind that having fixed income in your allocation doesn't necessarily mean debt mutual funds, although it could also mean debt mutual funds, and it would sound strange coming from me, but you could actually define your asset allocation table more broadly to say, do I have enough savings instruments which are fixed in nature, right? So let's say people have exposure to deposits, people have exposure to provident funds, etc. However, the true case for debt mutual fund will come when you are able to evaluate these versus other fixed rate savings options that you have on the table, and then conclusively arrive at an inference that the debt mutual fund is better. Right? Only then will you be convinced to actually, increase allocation to debt mutual funds. But first, you have to be able to buy into the idea that fixed income is necessary as a counter-cyclical safety net in your asset allocation table. And in round 2, you then think about whether these needs are already being met with my traditional allocation, or do I need to do more? And if I need to do more, how do debt mutual funds stack up, especially now with tax benefits gone and they being at par with other instruments.
It was pleasure talking to you. I think, a lot of investors who typically keep wondering about the space called fixed income, because many of them think that fixed income is a little complicated space. A lot of them think that equity is easier to understand. You put it in a manner that is easy for most to understand, and then they can obviously become better investors as well.
Glad to be part of Horizon Video Zine. Wishing your viewers all the very best. Thank you for the invitation today.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.